Ladies and gentlemen, good day and welcome to the Shriram City Union Finance Q3 FY22 earnings conference call hosted by PhillipCapital India Private Limited. As a reminder, all participant lines will be in the listen-only mode. There will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal for an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Pradeep Agarwal from PhillipCapital India Private Limited. Thank you and over to you.
Yeah, thank you, Zed. Good morning, everyone, and welcome to the Q3 FY22 earnings call of Shriram City Union Finance. To discuss the results, we have with us Mr. Y.S. Chakravarti, MD and CEO, Mr. R. Chandrasekhar, ED and CFO, Mr. Ravi Subramaniam, MD and CEO, Shriram Housing Finance, and Mr. G.S. Agarwal, CFO, Shriram Housing Finance, and along with Jason Ponte, Head Investor Relations. I would now like to hand over the call to Mr. Chakravarti for his opening remarks. Over to you, sir.
Thank you, Pradeep. Good morning, friends, and I welcome you to the earnings call of Shriram City Union Finance Limited for the third quarter of the financial year 2022. I would also like to wish you a very happy new year, as this is the first opportunity that I had to interact with you in the new year. I'm sure you would have had a look at the financial numbers and the investor presentations that we have uploaded last evening. Before I give you the details about our performance in the third quarter, I would like to briefly talk about the announcement made last month about the merger of Shriram City Union Finance, Shriram Transport Finance, and Shriram Capital into a single composite entity to be called Shriram Finance Limited. Today's earnings call is also the first opportunity for me to be able to talk to a larger number of our investors and analysts about this development, and I shall take it in order to explain the reasoning behind the merger plans. The merger idea was under discussion for a fairly long time within the group, but we could act on it only now after we had put in place a structure that is simple in constitution and should hopefully meet with regulatory approval. In order to arrive at an acceptable structure for the merger, the group ensured that the insurance and non-lending financial businesses were parked under a separate holdco arrangement, and that the intended merger would comprise only of lending arms plus that portion of Shriram Capital with stakes in these lending arms. As a result, the new company, Shriram Finance Limited, will have a promoter stake of 20.11%, and of the balance, Piramal Enterprises, Apax Partners, and PPG will together hold 16.7%. We, of course, have other esteemed and long-standing stakeholders as well with significant current holding in Shriram City, but I have mentioned these three investors because they either have a fairly major direct stake in Shriram City or in the holdco, or both. We would like to believe that all these valued partners will be with us for the journey which the Shriram Finance Limited will embark on. We count on their support as well as on that of the other stakeholders who have proposed their faith in the company. We expect several benefits to accrue to Shriram City from the merger. On the lending side, there would be easier access to the customers and geographies where Shriram Transport is a strong player, thereby enhancing cross-selling opportunities. Shriram City's customer acquisition cost for the augmented business would also reduce because of the established presence of Shriram Transport in these segments and geographies. Besides which, we would also be able to share each other's data. Further, a significant number of Shriram Transport customers are owners of small businesses, and this would present an opportunity to sell, to offer them MSME-oriented loans, a product specialization of Shriram City. Two-wheeler loans, an area where Shriram City has a dominating market share in the domestic lending landscape, and also gold loans would be offered across more locations. The addition of geographical markets would also enable the product suite of Shriram City to expand in a time frame shorter than earlier planned into locations hitherto unexplored and by the company. On the liabilities front, Shriram City would benefit from Shriram Transport's higher credit rating and successful efforts at raising debt from outside India. Advantages would be present while negotiating with domestic banks and institutions too, because as a standalone NBFC, both Shriram City and Shriram Transport compete for credit lines from the same set of bankers. The merger would enable Shriram Finance Limited to negotiate with lenders from a position of strength because of the size of the loan book, and of course also because of the dominance in products such as CV financing, MSME loans and two-wheeler loans. Borrowing costs therefore are expected to either decline or hold steady depending on the market and the regulators stance that the regulator is going to take going forward. Shriram Finance would be able to unitedly address the considerable number of fixed deposit holders of both companies without cannibalizing each other's deposit base. Significant opportunities exist in cross-selling products such as life and general insurance, since both companies currently in a limited way distribute these products. Digital initiatives undertaken by both companies would now be unified under a super app, which Shriram Finance will roll out, thus improving efficiencies. Cross-selling of loans to each other's customers would deepen productivity in the merged entity. Simply put, Shriram Finance would have a much larger geographical and customer canvas to paint on. I emphasize here that Shriram Capital would merge into Shriram Finance with no baggage in the form of assets or liabilities. Shareholders of Shriram City and Shriram Transport are therefore not placed at any disadvantage by Shriram Capital's presence in the merged entity, as there is no purchase of assets or taking over of liabilities involved. There is therefore no room for any holding company discount. Now, to address the matter of financial performance in the quarter, it gives me a great pleasure to report to you that the consolidated disbursements of Shriram City and Shriram Housing at rupees 8,398 crores were higher by 23.6% year-on-year and 19% quarter-on-quarter, and represent our best performance ever. Consolidated AUM at 36,853 crores was up by 16.3% YOY and 6.3% Q-on-Q. Consolidated top line at rupees 1,860 crores grew 18.5% YOY and 8.5% QOQ. And consolidated net profit at rupees 322 crores was higher by 7% QOQ and 5.9% year-on-year. We have therefore sustained our performance in Q3 and will strive to close out the year on a good note as well. On a standalone basis, Shriram City disbursed rupees 7,630 crores worth of loans in the quarter, which is higher by 23.1% YOY and 18.8% QOQ. As I mentioned earlier, these have been our highest ever quarterly disbursements. Q3 was the festival quarter for us, so disbursements were led by two-wheeler, which grew by a whopping 54.5% Q-on-Q. Other products also performed well, and most hearteningly, SME loans grew almost 90% year-on-year and 8.4% quarter-on-quarter. We therefore think that the MSE segment, which forms the bulk of our loan book, has weathered the effects of COVID-19. Assets under management at 32,247 crores grew 13% year-on-year and 6% sequentially. Profit after tax at 293 crores grew 3.6% sequentially and 4.6% YOY. This PAT represents our highest numbers in 8 quarters. Our collection efficiency for the quarter was at 103%. The rule regarding the daily stamping of NPA, as promulgated by the RBI, did impact our gross stage 3 delinquencies, as they came in at 7.3% versus 6.86 in Q2. However, on a like-to-like comparison, that is without considering the new RBI rule, our stage 3 actually improved to 6.61% in Q3. This is an important variable to which I would like to draw your attention, and I would also like to emphasize here that our loan losses continue to trend at historical range between 2.5% to 3%. Credit costs were 2.79% in Q3 Net NPA as of December 21 stood at 3.98%. Also, we expect no major increase in our stage 3 number as we move into the next few quarters. In fact, we expect these numbers to trend lower over the midterm. Our branch network now stands at 986 full-fledged branches plus another approximate 500 feeder locations. Our manpower count is 26,920 employees. Our one-time restructuring levels at 315 crores was less than 1% of our AUM. And the COVID-related provisioning now stands at 511 crores. Our loan yields and net interest margins continue to be robust at 21.72% and 13.44% respectively. Pre-provision profits at 606 crores were the highest in more than 3 years. The quarter saw us continue to develop our digital products. Our express two-wheeler loans and contactless personal loans were introduced over the last 6 months, and we are happy with the results. In fact, in the business express two-wheeler loan product, we have booked close to 18,000 loans in 2 months. We have introduced our online gold loan product on a pilot basis in some branches and are monitoring the performance. I'm also happy to tell you that we have now started disbursing gold loans in about 70 locations in Punjab, Haryana and Rajasthan, which we will probably in the next 3 months, we will be covering our entire branch network in this geography. And currently, we have reached a disbursement volume of about, additional volume of about 10 crores in these 70 locations. On the resource side, we raised 5,660 crores in the quarter, and the average door-to-door maturity was 55 months. We carried a liquidity backup of 5,027 crores as at the end of quarter, and we possess sanctioned and undrawn credit lines of another 939 crores. There were positive developments on the credit rating from all the 4 rating agencies post the announcement of the merger. All the 4 rating agencies, CRISIL, ICRA and CARE Ratings, have reaffirmed the long-term ratings at AA and placed the ratings on watch with positive implication. India Ratings has revised the outlook from stable to positive and reaffirmed the ratings at AA. FD Ratings is from ICRA and is at AA plus, and short-term ratings continue to be at A1 plus. Our subsidiary Shriam Housing Finance continues to keep up the good work. They have registered quarterly disbursement of 768 crores, their highest origination since inception. Assets under management at 4,606 crores grew by 47% YOY and 8% sequentially. Their cross-sell program called Grihapurti contributed significantly to their performance in the quarter. From 2% of home loan originations, Grihapurti now contributes 11% to quarterly home loan originations. Shriram Housing is now the most widely distributed affordable housing finance company in South India. Q4 will see the launch of Grihapurti in Gujarat. Shriram Housing's gross stage 3 at 1.49% was the lowest since March 2014. With this, I conclude my opening remarks, and now we are open to take questions. Thank you.
Thank you very much, sir. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking questions. Ladies and gentlemen, we will wait for a moment while the question queue assembles. To ask a question, please press star and 1. The first question is from the line of Sanket Chheda from Batliwala and Karani Securities. Please go ahead.
Hi sir, congrats on a very good set of numbers, particularly on growth. The numbers have been quite encouraging. My question is on the stage-wise movement. Now, even if we compare on a like-to-like basis as per the old reporting, the stock of stage 2 has gone up beyond the improvement that we see in stage 3. So I understand the 25 basis improvement in stage 3 would now sit in stage 2, But even adjusting for that, it has gone up 45 bps, one. And second, it says that there was no inherent improvement in stage 2 or inherent movement from stage 2 to stage 1. So any light on that?
Yeah. So, good morning, sir. Actually, if you see the stage-wise movement, there is just improvement in the stage 1. Only stage 2 actually was 11.96 has gone to 11.97. In fact, it is on the same level. So stage 1 has come down by 0.45 and stage 3 has gone up. But basically, this is consequent to the RBI recognition. If RBI the day-wise is nothing. So there is, if before calculating the staging as a 3 has actually has come down to 6.61.
No, so I'm sir not seeing the numbers of the new classification at all. I'm saying even if we compare on a like-to-like basis, you have also reported what it would have been in case of old reporting. There I am saying the stage 2 number has rather increased. So one, there was no inherent improvement from stage 2 to stage 1, and second, there was rather an addition to stage 2. So why is that happening with collections and everything improving?
Correct. So basically what's happening here is from the March 20 onwards, you see there is which was your stage 1, which was at 86%, is now still has not come back. I think it will take some more time before we can get this numbers back to the March 20 numbers. This is it's basically a COVID effect where we are able to select the arrears now, and the current will take some more time to get back. The play is mostly between stage 1 and stage 2, and it's not. We were able to arrest it from moving into stage 3.
Sir, actually one point I like to add is if you see historically pre-COVID level, we have around 15 to 16%. In fact, consistently it is coming down only this quarter. But if you see last 2 years, stage 2 has been historically at 16%. Now it is around 11.9 something. It is coming down.
Yeah, sir, I understand that our performance, particularly in COVID times, has been resilient. My question was just about this quarter. Anyways, on growth, sir, now that we would be heading into the merger-related processes and all, last 2 quarters growth has been very strong. But how do you see it for maybe next 3-4 quarters as far as just crop is concerned?
See, I'll put it this way. The merger is only the business of probably the top 8-10 people as of today. So none of the business team is disturbed or involved in this process. So on the growth front, the teams are committed. You've seen this, right? Even post the announcement and all that, the teams have not slacked down, and we hope actually the this quarter to be strong in terms of MSME disbursement. So on that front, there are no worries.
Okay, sir. Okay. So that were the 2 questions from me. Thanks a lot.
Thank you. Before we take the next question, we would like to remind participants that you may press star and 1 to ask a question. Next question is from the line of Ankur Jain, who's an individual investor. Please go ahead.
Yeah, hi. Thank you for taking my question, and congratulations to both SCOF Standalone and Shriam Housing Finance for a superb performance. I wanted to know about the strategy of the merged entity on the credit assessment side, because right now, as I understand, there is a lot of touch and feel in terms of credit assessment, visiting the customer's premises, meeting the customer. So when both the entities get merged, how is it going to get changed? I mean, will it be some centralized credit assessment that will take care of this? And will the branch managers be still in a position to visit all the customers? Because that is our earlier strategy.
See, fundamentally, both SCSC and SCOF are basically, as you said, more touch. basically high-touch model that we are operating in, particularly on the SME side of the business as well as the truck financing side. So that will continue. There is no change on the way that you are going to look at it. But even now, there are all certain functions are actually handled from a hub level. The basic credit, see, the branch manager and his one above are particularly involved in the credit decisioning of up to certain value, ticket size. If anything beyond that, there is one more level up which will get involved. So in that sense, there is no change. Only the documentation, cross-checking through bureaus or what if you need to cross-check through bureaus, the KYC validation, all that has already moved to a hub. So this is how it will happen. Fundamental assessment of the customer at a ground level, branch level, cross-check of customer financial, rest of the work that can be done on a digital, that can be taken care digitally has moved to the hub model.
Okay, so the credit assessment will continue to be same as we are doing currently.
Yeah.
So in that sense, the main the lever would be to basically train the employees. Same employee would be trained on both. I mean, a SCOP employee would be trained on truck financing, and a truck financing guy would be trained on SCOP products. Is that correct?
Eventually, but immediately in the next 1 year, what we are trying to do is pick up people from both the organizations and cross-pollinate these people. So basically, pick up people from staff who are working on MSME or a two-wheeler, move them and place them. Some of these employees move them and place them in HDFC offices. Similarly, from HDFC offices, pick up the second-line people and put them in SCOP offices.
Okay. So yeah, fine.
Sorry?
No, please go ahead.
Yeah. So that's the way we want to. See, basically, these guys would be, say, for example, MSME guy would be sitting in an HDFC office and start. The team will be generating leads, and this guy would be looking at the credit processes. So it's basically kind of an on-field training kind of a thing where this person, the SCOP guy, would meet each of these customers along with the HDFC guys and work along with this guy. So eventually, the people of both the companies would be equipped with, probably it will take about a year and a half before they can understand how this is being done themselves.
All right. Thanks a lot. That's it.
Thank you.
Thank you very much. Next question is from the line of Chandrasekhar Sridhar from Fidelity International. Please go ahead.
Hi, good morning. I had a few questions. Mr. Chakravarti, 3 questions for you. One was, any reason why the used two-wheeler product is now isn't growing? Is there some recalibration which you have been doing? Because now we've seen quite some time of this business, and the NPLs pretty much seem to be where the two-wheelers are, but hasn't grown for a year. That's question number 1. Just number 2 was just on the LAP product. Till when will you pilot? How long will you wait and pilot and wait and see the results and before you think of scaling? And how does this fundamentally differ from the LAP at SHFL? Third was just the early thoughts on some of these digital initiatives, no contact two-wheeler and personal loan lending. I mean, fundamentally, our strength has been the touch and feel and trying to assess from front. How are the underwriting checks here different from what we do typically? And a couple of questions for Ravi. Just on SHFL, I noticed that the share of construction financing has been increasing, and it's actually it's gone up to about 260 odd crores from about 113 crores last year. Just what's the thought process around where do you want to see CF in this book? And the last was a glide path on cost to income at SHFL, because we have a reasonably large book right now, somewhat comparable to some of the peers. But the cost numbers just a glide path. Thank you.
Ravi, you want to go first?
I'll answer the construction finance bit first. Look, construction finance is not a focus area for us at this point in time. Construction finance area is more a feeder into the retail. So our strategy on construction finance is largely to finance builders from whom we can have a reasonable amount of retail offtake. Now, we have not been very successful in that because we have not done too much of it. Where we want to see the construction finance book is somewhere in the 5 to 7% range. And 5 to 7% of our total AUM would be the construction finance book. As of now, it's about 5%, which is and it's kind of stayed between 4% to 5% over the last 1.5 years. In terms of disbursals, it will be about 10 to 15% of our disbursals, but construction finance runs down pretty fast. As a product, we have our amort scheduled in such a manner that we take out most of our payments in the first 50-60% of its receivables. So essentially, these, even though we book these loans for 3 to 4 years, these run down in about 1.5 years. So that's, in a sense, our construction finance outlook. I don't think it will go beyond 7%, at least in the near future. So that's one. Two is, you asked me what is the difference in you asked what is the difference in the SHFL LAP and the SCUF LAP. Actually, SHFL LAP is just a byproduct in the sense that because it's property, because the assessment process is at least the constituents of the assessment process are very similar to home loan assessment in terms of valuation, legal, etc. And because we have the infrastructure, whatever loans come our way, we do. We don't proactively go and look out for LAP. And that is clearly a domain of SCUF. And at this point in time, both do very little LAP, so we don't really compete. But if we get to a stage where one of us has to do it and the other has to let go, it will be SHFL will let go and SCUF will continue the product. So that's the way we've envisaged LAP. Your third question was on cost to income. On the cost for SHFL, well, SHFL is a high growth machinery at this point in time. We are in the investment phase at this point in time. And if you go back and look at how we are growing, one second, just hold on. If you look at our last 1 year, we've added a lot of people. We've invested in Grihapurti, which is a very large project for us in AP Telangana, where we have set up our infrastructure in 178 geographies. We are opening up roughly about 25 branches between Tamil Nadu and Karnataka. We are starting Grihapurti in Gujarat, where we'll actually open up 40 new locations riding on the group infrastructure by putting in resources in those geographies. So in the last 2 quarters alone, about 8 crores of investment has gone into these two initiatives that I just mentioned. And this particular year, about 15 to 17 crores of expense would be in investment for growth. Today, we are doing about 230, 240 crores a month. With this investment, we will be on a steady state building up an infrastructure for about 325 crores to 350 crores of disbursals per month. And that we will reach by April most likely. So this investment will pay off only next year. At this point in time, we are focused a lot more on building an organization, building a high growth engine. And most of the expense increase that we are seeing is actually towards that. If you knock that off and look at our steady state numbers, we will be pretty much in line with most of the competition. FY23, I expect the cost to AUM to settle around 3.2 or thereabouts, and FY24 it will settle down at about 2.75%. And in steady state, it will be somewhere between 2.5 to 2.75. So did I leave out any other question or any clarifications you have, please?
Yeah, just a clarification on this. Just in the lab, when you say was byproduct, this would be to the existing customers. My understanding was the Scuff lab is open market. So these
is also open market.
Okay.
SFL is not for existing customers. You know, in fact, you should ideally avoid giving home loans and lab to the same customer because that's asking for trouble.
Okay.
So I don't think we have any customer who's got a home loan and a lab both from us.
Sure.
Okay.
Yeah.
Coming back to the used two-wheeler finance, see, in the last few months, there was a slowdown. Specifically, we were focusing on the festival season. The entire team was focusing on new two-wheeler business. Dealer focus because they had to spend a lot more time at the dealer outlets. Probably from February, January also because of the Concall season, they were all busy. So it will come back to the regular run rate in this quarter.
But now that you've spent enough time, doing this business, you're not comfortable that this business can continue to scale. It's not. You have enough history now of the product to know whether.
Yeah. We are quite comfortable. We are quite comfortable there.
Okay.
Probably down. I think in another 6 to 9 months' time, we would probably be actually increasing the volumes. With the help of the SCSA team also, we will start increasing these volumes. Your second question on digital. Hello?
Yeah.
So, can you just repeat your second point? I just noted it as digital.
Yeah, just on this, this is no contact two-wheeler lending, personal loan lending. Just, one of the, what you have got to the table is obviously the whole touch and feel and understanding the customers.
Exactly.
So how does this underwriting checks differ from what we're doing regularly? I can understand the speed.
Let me elaborate the idea behind this. The idea here is, there is a section of customers, there is a section of people that we are not reaching today. Typically, the below 30s, young people who would prefer to transact with their mobile or on a laptop and not get into a physical, travel, go to the showroom. They already decided what they want. So we actually wanted to tap this segment of customers because we are already pretty strong in the semi-urban rural, and we thought unless we have a digital solution, it is difficult to build a sizable number or a reputation in the urban markets. So that is the background with which we have started this. And to be honest with you, if you look at the entire digital leads that we are generating, they are coming from about 18-20 cities. So the idea now is to focus on these 18-20 cities, build the capability to deliver all products there. So we are working on that now.
How does the underwriting differ from the existing the underwriting?
There is a lot of difference in underwriting in the sense you are looking at a lot of parameters. You are looking at CIBIL scores. You are looking at bank balances. You are looking at their income levels. So then we also work with a couple of third-party service providers where you integrate certain APIs and then build a scoring mechanism there. So it's basically there is no manual intervention in this in the whole process. Whereas in my regular business, I do have somebody talking to the customer, somebody going to the customer's house, the office, verifying the addresses, making sure the addresses are right, and then do a neighbor check. Then look at the income statement, and then credit team takes the decision to release. Whereas here, majority of it is not majority, there is zero human intervention. Customer gets, end of the day, customer gets approval and he gets a coupon. All he has to do is go to the dealer and present the coupon and take delivery of the vehicle. So it's basically majority of it is through electronically done, where the customer uploads his KYC, uploads his bank statements, and with the help of, as I said, in a few integrated APIs, you actually go and cross-check the document submitted to you. Plus, CIBIL score. So all of this is used to arrive at a score for the customer and give an approval to the customer.
Sorry, just to hop on this, is it safe to say that the quality of the customers is one notch better than what you would typically do on the two-wheeler side?
Quality of the customer, see, as of today, to be honest with you, this is also done after looking at my data for the last 6-7 years of the numbers that I have done physically, right? The scoring is arrived at with the experience of my business in the last 6-7 years of two-wheeler business. So, I'm 100% sure the delinquency levels here would be lower than my touch model. That is what we, as of today, preliminary feeling is. We'll have to see, because since it's still a pilot, we have not done too many numbers. It's just 18,000 numbers we have done. So we'll have to wait for at least another 6 to 8 months before we understand how this is performing. But early signs, if there is a 100% hit rate, as of today, there is zero bounces in the 18,000 accounts. So we are hoping it will continue.
Thank you.
Thank you very much. Anyone who wishes to ask a question may press star and 1 at this time. Next question is from the line of Nischint Chawathe from Kotak Securities. Please go ahead.
Hi, a couple of questions from my side. Maybe first to Ravi. The repayment rate in housing business appears to be a little bit on the higher side. So, what do you think? Are the prepayments very high, and where do you think this sort of settles down? The other is, how comfortable are you with a 20% coverage on stage 3 loans? And just the third one is that if I look at the quarter-on-quarter rise in stage 3 loans, it looks like some of the non-focus states like Kerala, UP, West Bengal, probably there was a decline, but there was a rise in the other states, unless maybe my reading is not accurate.
Ravi sir?
Yeah, can you hear me? Yeah. Okay. As far as the prepayments are concerned, there has been an increase in prepayment in this quarter primarily because of 2 large value loans which got prepaid. And these were loans which we have been trying to push out of the system, and because we didn't want those large value loans in our system, and that's why it seems higher. Otherwise, if you knock those 2 loans out of the system, we would actually be pretty much normal. Our average repayment rates is somewhere around 5.5% to 6% is the BT out rate that we have per annum, and that's pretty much par for the course. As far as what is the second question?
Non-focus state.
As far as the NPAs are concerned, no. In fact, if you look at our overall NPAs, they have dropped from where they were in March to by about 4 crores or thereabouts. It was about 66 crores in March and it's about 69 crores now, but by and large static. We have a few sticky accounts in the old book which we are struggling to resolve, which hopefully will get resolved this quarter. But there has not been any significant rise in the non-focus states that you're talking about. For example, in the east, it's been fairly static. In the west, it's been fairly static in that sense. And even in the non-focus states of UP and a few others, not much has increased. In fact, we've actually, in our investor deck, which is on our website, we've actually put out a slide which gives you the stage 3 in our focus states and non-focus states. So if you look at it, they have been fairly static, and even the performance of the new book in these non-focus states has been pretty good. The maximum that you have is about 0.6, 0.7% GNPA in the non-focus states. So no concern there at all. And happy to report that our growth in the focus states has been significant. Roughly 90% of our disbursal now comes from the focus states, so which are running at about 0.27% NPA. GNPA.
That was my question, right? That your performance on the non-focus state, and I was exactly referring to that slide. Seems to be at least on a quarter-on-quarter basis seems to be better than the focus state. So is it something to do with the fact that you had a couple of sticky delinquent accounts which affected this quarter? Or?
No, sorry, I didn't get it. You're saying that our performance in the focus state seems to be better than the non-focus states, right?
The other way around.
No. If you go back and look at my my focus states, stage 3 is 0.91.
No.
And the non-focus states stage 3 is 10.28. And in fact, if you look at my stage 3 in the last quarter, my focus states stage 3 was 1.13, and that's dropped to 0.91 this quarter. My stage 3 GNPA last quarter in non-focus states was 13.61. That's dropped to 10.28. So overall, the stage 3 in the non-focus states has dropped. Stage 3 in the focus states has dropped, and the stage 3 in the focus states has dropped by almost as much in terms of percentage as it has dropped in the non-focus. 13.61 to 10.28 and 1.13 to 0.91. So in terms of percentages, it's almost the same.
Sure. And
so we don't have an issue in it. Yes, we have a few sticky accounts in the non-focus states, which if we resolve one or two of them, it will lead to a significant drop. But overall, on the portfolio front, our focus states continue to perform well. Our new book continues to perform well, and it's only for example, take East. Out of the 69 crores that I have, East contributes to 21% of 21 crores out of the 69 crores. And I hardly have 3% of my AUM in the East. I'm still sticking on to East largely because if I exit the East, then I will struggle to even collect this. So I would rather be there, do a little bit of business there, and collect these outstandings. And you knock off this 20 crores from my NPA, that's 1/3 gone. That's about 0.6% overall gone. So out of the 1.5% GNPA that I have. So it's only these few specific geographies where a few sticky accounts are creating an issue. But otherwise, I think, look at the new book. New book is about roughly 4,000 crores now. And that's running at 0.28% GNPA. So it's a good story emerging, and on the focus states, 0.91%, I think I will take it any day.
Sure. The ECL coverage of 20%, are you comfortable, or you think this kind of?
So 20% is largely because one, we are also providing for the RBI circular staging at 15%. Now, averaging out, it works out to 20. Otherwise, on the regular stage 3, my provisioning is about roughly 23%. And that's sufficient because these are all, as I said, out of 69 crores, only about 10 crores is the new book, and the balance is all the old book. And new portfolio is performing brilliantly in terms of, recoveries, in terms of ability to sell properties and recover your money. So we really don't think that we will need anything more than this. And two, overall, I'm actually 1.4% provided on AUM, which at this point in time is among the better ones in the affordable housing finance companies in terms of provision to AUM.
So perfect. So as I understand this, the broad policy is that all the loans which are sort of true stage 3 loans, you will provide at the ECL rate, and all those loans which kind of fall into NPL category, which are a part of stage 3 now, you will probably provide at the RBI rate.
That's right.
Okay, sure. If I can squeeze one or two questions on SCUF.
Yeah.
One is, your stage 3 coverage for SCUF is down, I think mostly in the business loans. Is this because of a very similar sort of a policy that, the stage 3 rise because of RBI definition, you'll probably provide at a lower rate?
Yeah, once again. My colleague Kritika will take that question.
Yes. On the coverage ratio, the LGDs are computed on a yearly basis. So what you see as a difference between the quarter is more to do with the product segment wise. So otherwise, the LGD computation is more on a yearly wise axis.
So is the policy similar to that of Shriam Housing, where you probably have an internal breakup between stage 3 loans for those which fall because of RBI definition and those which are sort of stage 3 as per the previous sort of a calculation, and have different different PCRs on them, or would you kind of everything that goes into stage 3 you probably put in the same coverage?
Everything which goes into the stage 3 will have a similar coverage.
Sure, got it. And just one last.
The coverage is on the product segment wise. So between the two-wheeler and the SME, there will be a differential, but anything which goes into the stage 3 will have a similar coverage.
And I think within SME itself, we can see the coverage ratio going down from 60 to 50. So maybe that's because I guess the sub-segment of SMEs will probably have different.
You are right.
Perfect. And just one last question is, on again Shriam, again on SCUF itself. If you could give some guidance in terms of, where you see the operating expense growth sort of settling down. Because I think this quarter was almost like a 25% growth, 33% growth in employee expenses. So where do you see this ratio really sort of?
It should be around between 38 to 40%. Hello?
Yes, sorry. Okay, but I think currently you are at 42, I thought last quarter, so probably this comes
down. 42, this is also because cost of ESOPs, some of the ESOP cost has been baked in here. Second one is also, if you look at the quarter, festival season quarter, there is a huge number of two-wheeler business which was done, and which entails dealer payout, upfront dealer payout. Mm-hmm. So basically, these are the two that has contributed to this, and also about 1,600 employees getting added. But then I think, as I said, on a steady state, we should be between 38 to 40, probably a couple of quarters from now.
Sure. Okay, and just one last question, related to this. The movement in yields is purely because of change in business composition, or have you raised lending rates in any of the segments?
Yeah, it's because of the change in composition. You're right.
Sure. Perfect. Those were my questions. Thank you very much, and
thank
all
you.
the best.
Thank you. Next question is from the line of Prakhar Agarwal from Edelweiss. Please go ahead.
Yeah, hi sir. Three sets of questions. First, more fundamental from understanding basis. When I looked at the RBI circular, essentially it was based on a rule-based provisioning, while for ECL or India's we are more from a behavioral aspect perspective. So in that sense, why would our at least these numbers will reflect, stage 3 rise will reflect because of RBI rule, or is that there is a convergence between gross NP and stage 3 in our case?
Sorry, we are not able to, your voice was not very clear. Can you repeat that again?
Sure, sir. So I was talking more from a fundamental perspective. Now is it clear?
Yeah, please.
So I was saying when I look at RBI rule, it was more to do with a rule-based provisioning and a rule-based framework. But when I look at Ind AS, it is more to do with behavioral aspect of customers. So how does that probably impact the stage 3 asset? So as to say, ideally it should have been that we are submitting whatever we are submitting to RBI on a rule base, that number would have been impacted, not under Ind AS. So just a clarification on that.
Yeah, I understand your question, but if you see the stage 3, in fact, we have also given in one of the slides there with RBI, without RBI. You go by the number.
Is your question, Prakash Kritika here? If I may just kind of understand your question, is it on the classification of stage 3 or is your question specific to the provisions which have been made for the stage 3?
No, ma'am. So I was asking more from a perspective that when you do a accounting under Ind AS, your accounting or a classification of a borrower under stage 1, stage 2, stage 3 depends upon behavioral aspect and not on a rule-based aspect. When I talk about 90 plus DPD or in terms of daily recognition norms, all these things are rule-based aspects. So how does that?
Yes, let me answer it for you. See, we have kind of classified the staging. So even if a customer on a day basis, he happens to be a 60 DPD as on the quarter end, but during the period, as per the regulatory requirement, if he has slipped to 90 and then has not paid the full arrears, we do show him only as a stage 3 asset. So, the possibility to show him as a stage 2 also, we have kind of adopted from the rule-based, which is the RBI requirement, and then shown these customers under the stage 3 one. Hope it clarified.
Okay, so 7.3 is also your gross NPA numbers. Stage 3 is equal to gross NPA, if I were to just look at this. Okay.
That's the reason the stage 3 and gross NPA are shown as the same figure. While on the Ind AS regulation, it might still be a different number, but we have kind of considered the regulatory requirement as superseding and then classified everything. And so the stage 3 and gross NPA are one and the same.
Perfect. Now the second related question to this is when I look at your coverage ratio in stage 3, now given the fact that all these customers that essentially we are dealing with will have a volatile volatile earning component, and to that extent for them to clear 4 EMIs or probably to that extent upgrades will be relatively difficult. So do you anticipate that this sort of coverage that we were maintaining earlier would ideally go up for under new RBI regulations, or probably we are okay with 47-48% sort of number?
See, honestly, if you look into the figures, the coverage ratio or the provision requirement will actually come down if we were to kind of adopt a proper Ind AS logic. I mean, what I mean over here is the customer, while the classification is still as in gross NPA asset, there is every possibility the customer would be even only a 30 DPD. So I don't think there is a requirement per se to increase the coverage ratio from where we are right now, close to about 50%. In fact, if we were to take a 3-year kind of a view and then look at that, there is every possibility we can even look at a reduced coverage, but at the management level, we are not anticipating any reduction in the coverage. But I mean, the 50% which has been there historically in the range of about 50% should be adequate enough to take care of the stage 3.
Sure. Then the third is on small business, so business loans. So what is unsecured portion of our, if at all there is, what is the sort of unsecured portion in our business loans?
On the SME book?
Yes.
Close to about 15% is the unsecured portion.
And what would be yields on that?
Sorry?
What will be lending yields on that portion?
Yield?
Lending yields for unsecured MSME portion. What
MSME portion is about 18% unsecured.
Unsecured. So ma'am, just a follow up on this, when I look at few competitors who are operating in a similar geography, for unsecured portion, for a secured portion, they are lending at around 24-25%, and for unsecured lending, we are charging 18%. Where is the disconnect in this?
I mean, the lending rate of 24 pertains to a two-wheeler, not a MSME loan.
No, ma'am, so I'm asking, there are competitors who are doing MSME loan secured portion at around 24-25%, while we are doing unsecured MSME at 18%. So where is the disconnect? Because that particular competitor is also operating in a similar geography. So where is the disconnect? Why are we not able to, or is there something missing?
See, let me put it this way. The rates vary on the ticket size and the customers you do. If somebody is doing at 24% and 24-26% MSME lending, the ticket sizes will be 1 to 3 lakhs. Whereas for us, the ticket sizes range from 2 lakhs to close to 50 lakhs. So though the average is about 10 per lakh, the yields differ depending on the ticket size. So the average yield for us is anywhere between 18% to 18-19% would be the average yield.
Okay, and peak yield will be the highest yield that will be charging on a lower ticket size. What will that number be?
Sorry?
The highest yield that will charge on a smaller ticket size, that number would be what?
24%.
24%.
Perfect. That answers it. Thank you so much. Thank you.
Thank you. Next question is from the line of Shubhranshu Mishra from Systematics. Please go ahead.
Hi, sir. Thank you for the opportunity. A couple of questions. The first one is on the gold loans. I somehow missed out your initial comments on gold loans. Just want to understand, you spoke of some kind of strategy and entry into new states. If you can also dwell on what kind of ticket sizes we are doing and what kind of incremental ticket sizes we are doing, and what's the yield on the gold loan book. That's first. Second is on Shriram Housing Finance. Now we are a sizable housing finance company in the affordable space, almost 5,000 crores. So any plans to list it separately? Is there a timeline that we can look out? These are my two questions.
On the gold, the average yields are about 16-17%, and ticket sizes are typically between 30 to 40,000.
And you spoke of a few new states as well, sir, in your initial comment for gold loans, I believe. I missed that.
Two states right now, as I mentioned in the call, it's Punjab, Haryana, Rajasthan is where we are focusing now. So once we have reached the volume here, then we will look at other states. As and when the merger takes place, we would also be expanding into some of the HDFC branches.
Sure, sir. Thank you. Second question.
Ravi?
The second question on Shriram Housing.
Please go ahead. Okay. Can you repeat the question, please?
My question was that we are a sizable affordable housing finance company today. Any plans to list Shriram Housing separately? Can we look at a particular timeline for that?
Boss, at this point in time, let's focus on building this to a 15,000 crore company. And along the way, if we feel a need to list it, we will. But the reasons for listing have to be the right reasons. Just because it's a fad and the capital markets are buoyant is not a good enough reason to list. I think we are well capitalized. Parent is well capitalized. There's a fair bit of investor interest in Shriram Housing. So we would let it run the way it is running at this point in time, and we'll take a call when the time is right.
Sure, sir. Thank you so much.
Thank you. Next question is from the line of Ashwin Kumar Balasubramanian from HSBC Asset Management. Please go ahead.
Hello. I'm sorry if this question has already been answered, but just wanted to know the difference in the GNPA between the new RBI norms and without the new RBI norms, that 0.7% impact. Is that coming only from the daily stamping rule, or it's both put together, or were you already following the rule that if it slips into NPA, then you have to recover everything to upgrade. So just wanted to understand, is it a combination of the two or just one of them?
We have been following the second norm, which is the upgradation was only after the entire overdue had been cleared. So that was already in practice for almost 3 years now. So the only impact would have been on the day-wise realization.
Okay. So and just to follow up that, so in that case, your 90 plus as such would be different from what is shown as gross stage 3, right? Like I mean earlier, as per the earlier norms, because
kind of adopted is wherever the day-wise stamping and because of which the upgradation has not been done has also been shown both as stage 3 and as gross NPA. So there is no difference.
Right. No, but my question is, your 90 plus in that case would be much would be lower than that. Right?
On a practical basis, would be much lower. But because of the RBI,
if you can give some color on how much that would be, like out of the stage 3, how much will be cases where you have just not been able to upgrade and it's just.
About 70 basis points.
No, the 70 basis is the difference due to daily stamping. I'm asking the difference between what is the 90 plus and what the 90 plus will be lesser than what is in stage 3 because you have not been able to upgrade.
Upgrade, as I mentioned, almost for 3 years we have been following the rule of only after the entire arrears is paid, right, we do go for an upgrade. So that number, even historically if you see, irrespective of the circular, also we were following the upgrade only upon the entire overdue getting cleared. So for us, more of an impact is only on the day-wise recognition versus the month-end recognition.
Okay. I'll go back to that. Thank you.
Thank you very much. Ladies and gentlemen, that was our last question for the day today. I now hand the conference over to Mr. Pradeep Agarwal for closing remarks. Over to you, sir.
Yeah, thank you, sir.
Thank you so much.
On behalf of Phillip Capital, I would like to thank the entire senior management team of Shriam City Union Finance and Shriam Housing Finance and all the participants for joining us on the call today. Thank you and have a good day. Sir, if you would like to add any closing remarks or if we can close it.
Thank you, gentlemen. Thank you for the opportunity and thanks for your time. Thank you so much and keep safe. Thank you so much.
Thank you very
Very
much,
much.
management. Ladies and gentlemen, on behalf of Phillip Capital, that concludes today's conference call. Thank you all for joining us, and you may now disconnect your lines.
Thank you.